So Bill Ackman's Pershing Square USA just started trading on the New York Stock Exchange, and the ticker for that is PSUS. And the IPO was priced last night at $50 per share and quickly raised to over $5 billion. And a week earlier, as mentioned in the video I will hopefully link up here, AngelList launched a fund called USVC that lets regular retail investors buy exposure to Anthropic, OpenAI, and XAI for about $500. So this is greatly increasing the consumer's access to gain access to these private companies. And most importantly, Naval Ravikant chairs the investment committee. These two funds, though, are using the same legal structure to do completely different things. And what's interesting is that the structure that they're using has known problems that crypto has already solved. And that's what interests me in this regard. Both funds are registered closed-end funds under the Investment Company Act of 1940. And that is the same statute that governs mutual funds, ETFs, and bonds. But the closed-end part is what makes it different from a mutual fund. In a normal mutual fund, you can redeem your shares back to the issuer, and at the end of the day, NAV whenever you want. The fund manager has to keep enough liquidity on hand to handle multiple of those redemptions. And in a closed-end fund, you cannot redeem. And the fund issues a fixed number of shares, and if you want out, you have to sell it to someone else. So the manager keeps the capital permanently, which that's why this structure works for long-term stuff like activist campaigns or liquid venture investments. And the venture manager, frankly, doesn't have to worry about a panic redemption blowing up the strategy. In this, though, this is why Ravikant and Ackman both chose this wrapper, because they want to give regular investors access to strategies that historically required either $10 million or a net worth of a multi-year capital lookup with a general partner. So USVC is an AngelList one and is not currently listed on any public exchange, but it is available through them. And you can buy shares directly through the AngelList asset management at the end of the day. As of the March prospectus, the fund was about 44% deployed across 7 different companies, and the biggest position is XAI at around 20%, and the rest of that is between Anthropic, OpenAI, Crusoe, Sierra, Vercel, and Legora. So the fee structure at that is 1% management fee plus a 25% shareholder service fee. The bigger picture for USVC, though, is that tech companies are staying private longer than they used to be. The median age at IPOs has roughly doubled in the last 40 years, so most of the value creation now comes pretty much before any of it has hit public markets, which is great for some structures, but not typically great for retail, because they've been essentially locked out of that growth by accreditation rules and $25,000 fund minimums. So USVC, in my opinion, is a really good thing to be able to break that lockout. PSUS, on the other hand, is the Ackman one, and it does the same exact thing for a different asset class. And it's listed a closed-end fund with about $2.8 billion of the $5 billion raised came from the cornerstone investors in private placement. The rest of that, though, which was interesting to me, came from a public market subscription. Routers reported that the deal was oversubscribed, with institutions, which are important for crypto as well, accounting for over 85% of orders. The interesting thing to me about PSUS, though, that IPO'd today, is that since it's a bundled offering, when you bought PSUS at the IPO, for every 5 shares you bought, you got 1 free share of Pershing Square Inc., which is the management company itself. So you weren't just buying the fund, you were also buying a small piece of the firm that earns fees off of this fund and all of the other Pershing vehicles. Cornerstone investors also even got a richer ratio here. So the same wrapper, different asset classes, and USVC gives retail access to private AI companies. PSUS gives pretty much retail access to Ackman's concentrated public equity strategy. Most of the launches is pretty much going to cover some kind of call of synchronized regulatory event of the previous things that were happening. And it's pretty much just 2 managers that independently figured out that the closed-end fund is the only retail accessible structure currently within the current U.S. securities law that gives the manager permanent capital. But there are structural trade-offs to this. The closed-end structure works really well for the manager because they get permanent capital and they really don't have to worry about redemptions. And they can run long horizon strategies. But the trade-off is that the liquidity risk gets pushed onto the investor, and that risk shows up differently for unlisted funds versus listed funds. For USVC, which is unlisted, the trade-off in this case is straightforward because there's no secondary market. If you want to get out, your only option is the quarterly share repurchase program that the board suspends whenever it wants. Both funds, PSUS and USVC, both operate inside the standard U.S. settlement infrastructure, which means T-postponed clearing and restricted market hours and capital sitting in transit between trades. But the on-chain angle for this, though, which is interesting to me, is that a lot of the architectural problems we walk through which there are more, have pretty much already been solved in crypto world. So there are already a ton of people, specifically BlackRock, using Securitize to do RWAs. But most coverage of tokenization treats it like 2030's future state, but the rails are actually very established today. So on the token level, Solana has something called the Token 2022 program, which is an upgrade to the original SBL token standard. And it includes 3 features that pretty much matter for any regulated security on a blockchain. The first one is called default account state, which when you create a new token with this turned on, every wallet that holds this token starts out frozen. And the issuer has to explicitly thaw a wallet before it can send or receive a token. So you can do it off-chain, which is KYC and accreditation checks, and only verified wallets ever gain access to this. That gives you permissioned ownership over a permissionless network. The second is transfer hook, and every time the token moves, it triggers a separate program that runs on whatever compliance logic the issuer wants, which means whitelist checks, jurisdiction gain, OFAC screening, and whatever else comes with that. If a transfer fails this check, though, it does not go through, which adds a ton of security to this process. And the third to this is the permit delegate, which gives the issuer authority to freeze any wallet or clawback tokens directly, and that is the same authority a regulated transfer agent has in traditional finance. Multiple stablecoins that are all regulated all use them. So the precedence for this is that in late February, the SEC granted Wisdom Tree exemptive relief that lets their shares in the tokenized U.S. Treasury money market fund trade and settle 24/7, which was pretty historic in trading. This is the first time that the SEC has ever approved 24/7 trading for a registered 1940 Act mutual fund inside the U.S. regulatory perimeter. And the structure that Wisdom Tree used is called a dealer principal. So they trade the shares that they own from broker-dealer balance sheet against USDC. And the fund had about $730 million under management at the time of the relief and is live on 9 networks at this moment, including Solana. That ruling is the most direct precedent for what eventually happens with PSUS or USVC in my mind, because you don't necessarily have to tokenize the share at the issuer level. You can wrap the registered fund in a dealer principal liquidity layer that lets it trade against the stablecoins around the clock. For any USVC or any other type of shares redemption problem, there is another piece of infrastructure worth knowing about. And in early February, 2 firms called Multiliquid and MetaLayer Ventures launched a dedicated instant redemption facility for tokenized real-world assets on Solana. So the way it works is that a facility acts as a standing buyer of supported tokens at a dynamic discount to NAV, which pretty much allows any investor to exit instantly. So the liquidity provider in this holds the asset until the next issuer's scheduled redemption window, and the supported assets at launch include tokenized funds from Van Eck, Janus Henderson, Fasanara. That's effectively the on-chain answers to USVC's quarterly 5% redemption cap. On the NAV discount for PSUS, though, there's a different piece of precedent, and that is Anemoy and Centrifuge have been issuing tokenized funds on Solana for over a year. So they have a tokenized U.S. Treasury fund and a tokenized AAA CLO from Janus Henderson, and this year they launched a tokenized S&P 500 index fund called DSPXA in partnership with S&P Dow Jones Indices. So the S&P 500 fund is a direct template for tokenizing something like PSUS, a portfolio of public U.S. equities fund wrapped tokenized with on-chain transparency into how NAV is calculated, and a redemption mechanism is built into the smart contract. If PSUS were issued this way, the NAV discount problem becomes solvable through programmatic arbitrage. So you don't necessarily need, in this case, activist proxy fights or capital-intensive buybacks to close the gap. There's also backed finance, which issues something called X stocks on Solana, and these are one-to-one wrappers around real U.S. public equities held by a Jersey SPV regulated under Swiss law. NVIDIA X, Tesla X, SPYX, and Systi Plus tickers on that. So there's about $100 million in on-chain value within pretty much 2 weeks of launch, and they're available to non-U.S. investors only. And that is a major thing with crypto innovation in the United States, is that a lot of innovation is held overseas, but a lot of U.S. people do not have access to it. In January, though, Ondo Global Markets launched on Solana with over 200 tokenized U.S. stocks and ETFs. So they use a just-in-time mint and redeem model that sources liquidity directly from the NASDAQ and NYSE order books during market hours. So Ondo has filed a registration statement with the SEC to open this up to U.S. investors, but that filing is still pending. The last piece in this matter, though, is composability. In December, Superstate, which is a registered transfer agent that issues tokenized public equities, integrated their tokens into eligible collateral on Camino, which is the largest trading protocol on Solana. And that is the first time SEC-registered exchange-listed equities have ever been used directly as collateral in a live DeFi lending protocol. Galaxy Digital, Forward Industries, and Exodus all live there currently, and borrowers can post tokenized public equity, borrow stablecoins against it, and run capital-efficient strategies without selling the underlying position. For some context, though, on the broader RWA stack, there are now over $2 billion in tokenized real-world assets on Solana as of March, and Solana actually surpassed Ethereum in total RWA holder count for the first time that same month, even though Ethereum definitely still leads in TVL. So if all of this infrastructure exists on-chain, pretty much there's a very, very good reason why a lot of people aren't using it at the moment. The SEC has granted relief for tokenized money market funds, but they haven't granted the equivalent relief for a 1940 Act closed-end fund yet. So somebody, whoever is most daring, has to be the first issuer to file for it. The existing tokenized equity products pretty much are all restricted to non-US investors, and Ondo Global Markets has filed for that SEC registration to open up US access, but that filing is still pending. Until that path lights up, though, the most sophisticated tokenization rails on Solana aren't available to the same retail audience that USVC and PSUS are designed to serve. The issuers themselves have to want to do this, though, because essentially both of these entities can issue tokenized share classes alongside their existing shares, and the compliance tooling already exists and is built out. The dealer principal liquidity wrapping is a known template, and the technical lift is real, but is not huge. So the bigger lift in this would pretty much be strategic. I wouldn't be surprised, not for these two funds, but in general, we may see funds do this in the next 18 to 24 months. Because as Ondo gets a US registration, some major asset manager files for a closed-end fund tokenization relief. Probably one that's already done, a tokenized money market fund. The first tokenized 1940 Act closed-end fund will launch, probably around there. And within a year of that, the largest existing CEFs will offer tokenized share classes alongside their traditional shares. The last thing I want to flag here, which is a good thing, is the Robinhood angle. Ackman partnered with Robinhood for retail distribution of PSUS, and he did sit down with Vlad Tenev as part of his roadshow. Robinhood is the broker with the most aggressive tokenization roadmap in US retail, and they launched a tokenized US equities in Europe last year, and they publicly announced their own L1 chain dedicated to tokenized real-world assets. That's Tenev's separate agenda and explicitly not Ackman's direct agenda. However, the two tracks are sitting right next to each other, especially now since they're collaborated, and whether they meet on PSUS or the next closed-end round fund, that list Robinhood is worth watching, and is something I'm watching closely. So, in short, the legal wrapper has converged and the assets are catching up. So the on-chain rails are built, and they could be utilized. I totally understand why funds currently are not using them, as legally in the US specifically, they're not able to be done. But I am very excited that in the next 18 to 24 months specifically, we can see that happen. And I think it would be better for every American if that was to be the case.